This class is one of a set of classes on electronic payments and the use of electronic payments in the development of internet trading. Let's start by looking at electronic payment systems, EPS. Now this is a process that describes how value, usually money, is exchanged for goods and services or information. So EPS is simply a way of transferring resources from one account to another, payments in exchange for goods, services or information. It can be designed to enhance business operations and ensure better customer-supplier relationships. It's possible that this method of payment enhances the whole buying process. It's efficient, and providing there's confidence and it's secure, then the buyer can make purchases easily and efficiently, and the seller does not have the complexity of receiving cash, counting up the cash and making sure it tallies and then taking it to the bank, with all of the associated costs involved in that process. So this is an efficient system. In traditional transactions, we use different forms of money for different priced items. For example, for small items, we may use cash, credit cards for larger amounts, and bank drafts for the largest purchases. So we use cash for very small purchases. If you want to buy a cup of coffee, the chances are you'd use cash. Or if you're going to buy something in the local shop, you will use cash, chances are. You may use credit cards in a restaurant, or credit cards to buy a piece of electronics. And if you're going to buy something very large, perhaps going to buy a new car, you might want to use bank drafts, so that the money is arranged with the bank, it's available and ready to transfer from one account to the other. So we use different payment systems for different priced objects. EPS uses the same exchange process but uses an electronic intermediary to facilitate the exchange. So the electronic payment system, EPS, does the same as a traditional transaction, except it uses electronic resources. It uses electronic money. It uses digital money to transfer from one account to the other. Now, I said digital. This is actually perhaps an abuse of the word, but when we consider our credit card, we don't actually see the money. We see numbers in the account. We get a statement and we see the numbers that are involved. Now the statement itself may arrive electronically, but we see numbers. Then we make a purchase and the numbers are different because we've made a purchase. In that sense, that's how I mean electronic money and digital money in this context. Now it's necessary to validate the value of the exchange. It debits the customer and credits the supplier. It does it all electronically, and both sides must agree to the transaction, and both sides must have confidence that they're going to use electronic payment system. So there's no need for cash. It reduces transactions costs, as I said earlier. It greatly improves the possibility of just-in-time manufacturing and introduces real-time transactions without bureaucracies or slow manual processing. The seller does not have to count up the cash at the end of the day. There are security issues involved in that, and there's time, and then entering it into ledgers and taking it to the bank and so on and so on. It's cumbersome. So instead, the electronic system is simply transferring money from one account electronically to another account, and it's possible to filter the transfer so it moves straight into the appropriate account in the bank for the seller. So it's a very efficient system. Now, looking at traditional payment systems compared to EPS, well, money emerged spontaneously. Nobody planned money. Money just emerged. Before money, there was barter. Barter was inefficient. Barter meant trying to exchange one good for another. Barter involved something called double coincidence. Someone had an item that they wanted to trade. They had to find someone who wanted that particular item. But not only that, the person who wanted the item must be offering a product that that person wanted. So both people, they must want each other's products. Now, what's the chance of finding a person who not only is offering what you want, but who is willing to accept what you're offering? I know that sounds complicated, but double coincidence was the big bugbear for barter. So money developed spontaneously. It just emerged. Historically, gold was used. Gold maintained its value. It was scarce. It had all the properties coming from economic theory. It was scarce relative to want. People wanted it, so it had high value. So gold became an intermediary. People had items, they exchanged the items for gold, and then they could use the gold to buy the items they wanted. So it got rid of this problem of double coincidence. It overcome the problems of barter. Over the centuries, different forms of money evolved. We had paper money, and we had silver and copper, and all sorts of cultures had different forms of money. But the thing is, it's still emerging. We now have credit cards and debit cards. And we have different payment methods that are being developed all the time. Not only do we perhaps get our groceries in a supermarket by entering our credit card and typing in a PIN number, but it may be we get our items by simply waving our card over a piece of electronics. We wave the card over, near field technology, the appropriate sum is debited from the account. We don't even have to enter data. So it's becoming more convenient, but money is evolving all the time. In the past, you could ask a person how much money have they got on them. You could ask, count your money, and they may count it out to be a certain sum. Nowadays, the same person may have a credit card. Well, how much money have they got? Well, up to their credit limit, I presume. But their credit limit could be a lot. So traditional payment methods. Well, electronic payment systems operate in various ways. Exchange can occur electronically as follows. We have electronic financial payment systems. It uses a card to allow value to be transferred between accounts. So we could have the movement of resources from one financial system to another. We have internet payment systems. We even have the development of internet banks, PayPal and so on, which facilitates the exchange. The banks develop their protocols, their procedures, and the users follow those procedures to transfer resources, to transfer money from one account to another. We also have smart card systems where funds might be stored on the card, and as I said earlier, near field technology, simply wave the card over the piece of electronics and the appropriate sum is debited. So it's a convenient way of carrying money. Now, the role of EDI in electronic payment systems. Well, EDI, the electronic data interchange, is a way of sending information about a company or about its invoicing or its products or its stock holding or whatever, sending this data to another company, sharing information between companies. It did this by using an electronic link, and the data was coded in a certain structured format to make it accessible to the receiver. EDI has been used for a long time, and as I said, it applies to ordering, invoicing, information about all the relevant business data between trading organizations. So it's not a new system. EDI is a way of conveniently transferring information from one business organization to another. EDI is mainly a business tool, whereas electronic payment system, EPS, is used for smaller and mainly customer transactions. So EDI is business to business, transferring information, business to business information, whereas EPS mainly applies to transferring money from one account to another, and mostly from customers to some organization they're purchasing from. So there is a difference between the two. They are quite distinct. Electronic funds transfer, EFT, and electronic funds transfer at point of sale, EFT POS, are electronic tools used to effectively transfer funds between buyer and seller. This is the movement of funds between buyer and seller. So these are ways in which the funds can be transferred from one person to another. The electronic funds transfer model, well, we have the shop's bank and we have the customer's bank. The model relies on electronic transfer using terminal telephone, a modem and a computer and other pieces of electronic wizardry. At the point of sale, the electronic funds transfer at the point of sale, well, in this case the customer has got a payment card and uses the payment card with the shop. So in this case, the customer's bank, there's an electronic funds transfer from the customer's bank to the shop's bank, and the funds flow in the direction of the arrows as indicated. Of course, the card has to be validated before being accepted. Both sides to the transaction must agree on the terms, and in this case the seller must accept the card that's been used by the buyer. The seller must recognize the card and must have confidence that that card is suitable for the transaction that's been proposed. Now let's look at the requirements for an online trading system. Generally, customer electronic commerce uses recognized credit cards such as Visa or MasterCard. However, there's an increasing use of store cards and of various other types of card which are becoming acceptable. But really, this is a matter that must be dealt with between the buyer and the seller. The seller must agree that the buyer's card is acceptable. The store must possess the equipment, of course, to process the order, and there may be a time delay in processing. The resources, so there may be an issue about delivery, processing time, and the store must have the appropriate equipment. Generally speaking, for the major cards like Visa, it seems to be instantaneous. We go to a supermarket, we buy some groceries, we get to the checkout, we use our Visa account, let's say, enter a PIN number, and within a matter of seconds almost, the payment has been taken and we're free to leave the shop with the goods. And not only has the payment been taken, but of course it's been processed electronically and efficiently in the background. These costs must be compared with the cost of physical banking. For example, queuing up and dealing with checks and learning how to use the whole system. And so it's the traditional method of banking is much more costly and much more inefficient compared to what we're discussing here. From the customer's perspective, there's also an audit trail that has been produced so that all the transactions may be checked. If we use a Visa account, for example, at the end of the month we'll get a statement. The statement may arrive electronically, and we may look at the statement and check off all the items on the statement against our own receipts. And if there are items which don't tally, we may query those items with the credit card company. Now, the requirements for an online system. Well, for effective online trading, supply chains must be maintained. For online trading, it's important that there are effective supply chains. It's pointless making goods available online if the goods are not in stock, if they're not ready to be dispatched. Generally speaking, people who purchase online want an efficient service. Marketing an end product. Well, there are some principles to be followed when we talk about marketing and being effective in marketing and dealing with the end product. For a start, the information that's provided online must be high quality information, and there must be a lot of it. There must be testimonials about the product, and there must be accounts from previous purchasers of their experiences and so on. There must be confidence, in other words, in the product, and that should be portrayed to the potential buyer. And they must be easily to order online. It must not be a complicated system. It should be straightforward. Put the items into a basket and then go to the checkout online. Check out, have a simple form to fill out, and press the return key, and it's done. And all of these must be accessible to the consumer, or to the customer. All of these must be readily acceptable. So it must be that the customer is able to find the information easily about the product. It must be that the customer is able to go through the process of buying and do it painlessly. The three attributes constitute products that are readily saleable online. Of course, the products that are sold online should be suitable for sale online. Although nowadays the boundary is becoming blurred. It's possible to order groceries online. It's possible to purchase perishable products online and get them delivered and still enjoy the products before the expiry date runs out. The customer must feel that the purchase has offered value for money. Even though it's online, it doesn't change the customer's instincts. The customer still wants a bargain. They still want the product, good quality product, efficiently delivered, easily purchased, but also offering value for money. There are other factors that must be met in ordering to encourage customers to trade electronically. There must be administrative support for the online buyer. If something goes wrong, the buyer must be able to contact the seller and explain what's happened and get some redress if it's not their fault. And the company itself must recognize it's dealing in a global market. The internet is global. So it must be careful how it markets its products. Is it selling to one country only, or is it selling to a small group of countries, or is it selling globally? It should be made clear. And the government may intervene and regulate the markets. The government wants to raise taxes on the business, and it wishes to have some sort of controls over the types of products that are sold, the procedures that are followed in selling the product, the information that's supplied to make sure it's accurate, and so there are many issues involved that need to be looked into. For example, if the business is selling in one market but the servers that deliver the items are located in a different country, well, where is the business based? Who pays the tax? Who's liable for faulty information or bad practices? And there are security issues. There's always security issues. It's part and parcel of the being humans. Some people wish to cheat, some people wish to give false information, some people wish to get the product for nothing, and it goes on and on. Some people want to place a virus on the system to destroy the business. Some people wish to break into the system and steal user information. So there's a constant security issue, and there's a need for a security industry to protect this type of trading. EDI trading and purchasing in complex business environments. That's what EDI is. It's trading and purchasing in complex business environments. That's the electronic data interchange, which is different from buying online. EDI is companies dealing with companies and sending information. It's a use of internet technology, but it must be contrasted with the requirements that are needed for purchasing and trading online. And that's all we're going to deal with in this session. We're going to leave it at that, and this is the first class, I think, in a set of several classes on this topic, so it's worth looking at each of them. But let's leave it at that for the moment and say thank you for watching.